Before investing in stocks, I spent several months learning about investing and different ways to do so. Fast forward to now, it has been 1 year and 1 month since I made my first investment in the stock market. However, I still feel that there are many things I don't know about investing. Many investors, I think, will feel the same way. The fact is that you do not need to know everything about investing before you start, but it doesn't mean you can get into it if you don't know what you're doing. With that being said, I have chosen 10 things I think are important for every new investor to know before investing. Before we reveal 10 things about stock investment in this video, welcome to Be Financially Independent. Please take a brief moment, go down and smash the like button, and if you have not subscribed to our channel yet, what are you waiting for? Please do so and enjoy financial freedom. Let's get started. Number 1. Draw a personal financial roadmap. Before making any investment decisions, sit down and analyze your complete financial condition, especially if you've never created a financial plan before. The first step towards effective investing is determining your goals and risk tolerance, which you can do on your own or with the help of a financial advisor. Of course, there is no guarantee that your investments will yield a profit, but first, learn the facts about saving and investing, and then implement a sound plan. After that, you should attain financial security and enjoy the rewards of money management over time. Number 2. Evaluate your comfort zone in taking on risks. Every investment has some level of risk. Before you invest in assets such as stocks, bonds, or mutual funds, you must understand that you may lose some or all of your money. Securities, unlike deposits at FDIC-insured banks and NCUA-insured credit unions, are normally not federally insured. As a result, you risk losing your principal or the money you invested. This is true even if you buy your investments through a bank. The possibility for a higher investment return is the benefit of taking on risk. For example, if you have a long-term financial plan. In such a case, you are more likely to make money by carefully investing in higher-risk asset categories such as stocks or bonds, rather than limiting your investments to lower-risk assets such as cash equivalents. Investing purely in cash, on the other hand, may be beneficial for short-term financial goals. Individuals investing in cash equivalents are most concerned about inflation risk, which is the danger that inflation could outstrip and erode earnings over time. Number 3. Consider an appropriate mix of investments. An investor can help in the prevention against severe losses by adding asset categories with investment returns that fluctuate in response to changing market circumstances in a portfolio. Historically, the returns on the 3 major asset classes, stocks, bonds, and money, have not gone up or down simultaneously. Market factors that drive one asset category to perform well frequently cause another asset category to perform averagely or poorly. If the investment return on one asset category falls, you can balance your losses in that asset category by increasing your investment returns in another asset category. Furthermore, asset allocation is important because it has a strong influence on maintaining your financial goals. If you don't incorporate enough risk in your portfolio, your investments may not provide a high enough return to fulfill your objectives. For example, if you're saving for a long-term goal like retirement or education, most financial experts believe that you should include at least some stock or stock mutual funds in your portfolio. Number 4. Keep risks in mind. Be careful if you decide to invest extensively in shares of your employer's stock or an individual stock. Diversification in your investments is one of the most important techniques to reduce the risks of investing. Of course, it goes without saying, don't put all your eggs in one basket. You can limit your losses and lessen the swings of investment returns by selecting the correct group of assets within an asset category without losing high potential gain. You will be exposed to significant investment risk if you invest heavily in shares of your employer's stock or any individual stock. If the stock performs poorly or the company goes bankrupt, you will most likely lose a lot of money, or maybe your job. Number 5. Create and maintain an emergency fund. Most wise investors save enough money in a savings product to handle an emergency, such as sudden unemployment. Some people save up to 6 months' amounts of their salary so that they know it'll be there for them when they need it. You should first create an emergency fund. Once you've done this strategy, then focus on its maintenance. Maintenance is very important. You should consider this highly. Wait, hold on guys. If you've enjoyed this video so far, please give us a like. And don't forget to subscribe to the Be Financially Independent channel and type your insights in the comment section as you're watching this video. Number 6. Settle your high-interest debts. Loans and credit cards should be among the first issues you settle, or at the very least double down on, before you begin investing. Specifically, any loan with an interest rate equal to or more than 8%, since essentially what you'll gain from your investment in terms of interest is more likely to be the same. It does not make much sense to invest if the profits you make on your investments are lesser than the interests you pay on your debts. For example, if your returns are 12% and you're paying 14% as interest on your previous debt, you are at a loss overall. So here, instead of investing, it'll be better to use that money to pay back and become debt-free. Before you invest, minimize or try to settle your debts. The interest from them alone will kill your investments. Number 7. Consider dollar cost averaging. By maintaining a consistent pattern of adding new money to your investment over a lengthy period of time, you can protect yourself against the risk of investing all of your money at the wrong moment using the investment approach known as dollar cost averaging. You will buy more of an investment when its price is low and less of it when its price is high if you make frequent investments with the same amount of money each time. People who generally deposit a large amount into an individual retirement account at the end of the year or in early April may wish to consider dollar cost averaging as an investment strategy, particularly in a volatile market. Number 8. Take advantage of free money from the employer. The company will match part or all of your investment in many employer-sponsored retirement plans. If your workplace has a retirement plan and does not spend enough to receive the full match, you are adding free money for your retirement savings. Maintain your cash flow. In most circumstances, the most effective method to save for retirement is through a workplace plan. However, before borrowing from your retirement plan, thoroughly explore your options. Avoid using a debit card unless deemed needed. Today, borrowing money reduces the amount of savings available to grow over time, and eventually what you have when you retire. Also, if you do not repay the loan, you may pay federal income taxes and penalties. Number 9. Consider rebalancing your portfolio occasionally. Rebalancing is the best process for returning your portfolio to its original asset allocation balance. Rebalancing ensures that your portfolio does not overemphasize one or more asset groups and returns it to a reasonable level of risk. Maintain your plan. Buy low and sell high. Shifting money away from an asset area that is performing well in favor of an asset category that is underperforming may be difficult, but it may be a prudent choice. Rebalancing drives you to purchase cheap and sell high by reducing the existing winners and increasing the present runner-up. You can rebalance your portfolio depending on the calendar or on the performance of your investments. Many financial experts advise investors to rebalance their portfolios regularly, such as every 6 or 12 months. The calendar serves as a reminder when it is time to consider rebalancing, which is an advantage of this strategy. Others advise rebalancing only when the relative weight of an asset class grows or lowers by more than a predetermined percentage. Again, the benefit of this strategy is that your investments will alert you when it is time to rebalance. In either case, rebalancing works best when it is done regularly. Number 10. Avoid circumstances that can lead to fraud. Scams are highly advertised and used to trap new investors in the market. So, before investing in their securities, ask them some relevant questions and then check their answers. They frequently exploit a well-reported news story to entice potential investors and make their opportunity appear more real. Before investing, the SEC suggests that you ask questions and verify the answers with unbiased sources. You should also take your time and consult with trusted friends and family members. Talk with reliable investors and people before making any investment decision. So guys, we are winding up today's video. Investing isn't easy and there will always be risks involved. But given the inflation and rising cost of goods, sometimes a simple paycheck might not be enough to help you reach your financial goal. That's all for now. If you enjoy what you saw, please hit the like button, and if you're new to the channel, now is a great time to subscribe. After subscribing, don't forget to enable all notifications by clicking the bell icon. Do you want to hear more from us? Feel free to add your thoughts in the comments section. We will respond to you as soon as possible. Thanks for watching this video, and we'll see you next time right here on Be Financially Independent. Bye, friends!